Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there. Let's take a look and see what people are sharing. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics and subjects. I more freely share my opinions about those sectors and companies. We do have training sessions on a variety of things like technical analysis, fundamental analysis to some degree, depending on if it's a sector or individual companies. And I do talk about individual companies and kind of how I research them and what I think is good and bad, etc., with them. We do have a coupon code still going on, Mayday, Mayday. If you're interested, 50% off the first month to try it. Goes to normal pricing after, or you can get a larger discount on the yearly membership. So we're going to start here with yearly, and this is the NDX monthly. And I know a lot of people only look at charts and try to do fractals only, and I try to combine a couple of different things. I combine ratios, technical analysis, and market conditions. And that is what forms my opinions on these charts. It's not just the chart. So it says, what if a new bubble is just starting to form? What he took is he took the 1985 to 2000 run and is comparing it to 2000 to 2004, and he's comparing the potential fractal analysis where we could go on up. Now, there are some differences between these two. I'm not saying it can't happen. I'm just telling you what the differences are. The differences back in the 80s is that stocks were undervalued in relationship to commodities. We also had in 85 to 2000 a declining interest rate environment. So we had cheap stocks in a declining interest rate environment pushing the valuations up, all the way to 2000. In 2000 to 2004, in 2024, we have overvalued stocks in compared to commodities. We have an increasing interest rate environment. We are not having that tailwind like we had in the 80s and 90s. So the market conditions are not the same. The valuations are not the same. Does it mean that could this still go up the way that he has it? It could, but what that would then require, in my opinion, is a lot of money printing. And that very well could come. That could happen. So the money printing and the inflation in the system just overpowers the valuations on the stocks and also the market conditions of an increasing interest rate environment. And people are just getting rid of dollars to preserve purchasing power in any situation that they can. So that could occur. I'm just not betting on it because in that same situation and market conditions that I just described with a bunch of money printing, I think commodities will do the same thing. And I think they'll probably outperform this move here because of the undervalued nature. And if people are trying to preserve purchasing power in a highly inflationary environment, we've seen in history that commodities outperform in those environments and precious metals. So you could get that, but I would look at it through a ratio chart against precious metals or energy, which also has some really ridiculous setups. So everything I look at and the way that I evaluate these markets is through the lens of risk reward. The Nasdaq I wouldn't consider to be low risk. I would consider to be high risk because of the valuations. So that's what I'll say there. Here's URA. This is a uranium ETF. Very important uptrend channel bounce tomorrow. We're losing the 2850 open up a bearish air pocket, in his opinion. Tomorrow is the FOMC and CPI, so buckle up for some potential volatility here. We're right at that support level, and we'll see if that support level holds. Otherwise, we could see further downside in some of these uranium equities, unfortunately. Does that mean that the bull market is over? No, it doesn't. doesn't mean the bull market is over. In fact, I think it means is that the bull market is still early. And a lot of these pullbacks we saw previous bull markets. We've seen multiple 30 to 50% pullbacks in a lot of the equities in uranium last bull market. Some of them were, I mean, there was like 50% pullbacks 7 times last bull market. It was a wild ride and it was a tough ride to hold through with all that volatility. So I still think that the conditions are ripe for uranium to go way up. And maybe we're way earlier than what most people expect. A lot of people expect this just to go vertical. But, here's some observations. We've got the Nasdaq still going up. And maybe we're at the end of the Nasdaq bubble and that thing needs to pop and the money to rotate over into commodities, much like 2000, 2001. We could be that early. And people just don't realize it. And they keep wanting commodities to just go vertical. But when you're early in the bull market, they don't go vertical yet. Sometimes they get pullbacks and sometimes they consolidate. And maybe we're that early. It's tough to say with precision where we're at, but I think that we are early and we're kind of coming out of maybe a large consolidations in some of these commodity sectors. Here's the energy headline news. This is the API. So crude oil draw 2.5 million barrels. Cushing is about 2 million barrels. Gasoline's minus 2.5 barrels, which are all draws, and then a little bit of an addition of diesel, about 1 million barrels. So this looks like a solid draw across the board, and we'll see what Wednesday has in store for us when they release that data. North Star. So uranium continues to give back recent gains to either test the arc near the $73 area or form a much larger handle. So he's talking about this big perhaps cup, and then maybe we create a handle over in this circle area where we'll get another upsurge eventually with a consolidation that might be a little bit larger than what most people are expecting. So that's the uranium spot price, not the ETFs, but the spot price. Coming down to Tavi, he says government jobs are becoming an increasingly larger part of job openings. That tends to happen during economic downturns as businesses are forced to hunker down and reduce hiring while government jobs continue to inflate the data. So here's government jobs as a percent of total job openings. And we can see in slowdowns that the government jobs in terms of percentage of total job openings goes up. Do we have something similar coming? That is a big question mark. We don't know. And I know a lot of people are trying to line up when this potential slowdown comes after the yield curve's inverted like it has. And a lot of people have been unsuccessful at calling the top with any sort of precision. So we continue to stay inverted, higher for longer, and we are seeing data, and people are trying to pinpoint when this slowdown could potentially occur, if it does occur in the short term. So coming down to Patrick Karam, crude oil. This is, he's speaking my language now. I like talking about crude. United States 12-month oil. So 12-month oil is each candlestick is 12 months or 1 year. So that means every candlestick is year, 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 year. You can see we came all the way down. We broke out of that downtrend line, which started in 2014 and ended in 2021. Broke out. We've been consolidating here. And we are looking for a potential breakout of the upside. And that there looks very bullish to me. Why do I say that? Because we've got a big move up. We had a big selling pressure move, bearish engulfing, and it didn't really sell off. It just went sideways and consolidated right into a bullish engulfing here, and then is squeezing up against that resistance line. So if we do get a break here, and remember, whenever you get resistance here, that's generally from prior trading back here, which we have a lot of in 2010, 11, 12, 13, and even 14. So we ran into resistance, which is all this stuff over here. And if we can break, I think oil could have a pretty good run. I also think that will have an impact on interest rates. I think interest rates will go up if that does break out. If it does break out, I think anyone positioned in oil is going to make a bunch of money because oil equities and those companies are very undervalued. They're making a lot of money for what you're paying for. A lot of them are doing share buybacks. A lot of them are increasing dividends. I think it's an absolute excellent spot to be looking and to be in and participating in, and energy service companies as well. I think the whole group is going to benefit if oil or I don't know if it's an if or a when oil breaks that line or if oil breaks that line. Um, it's a great spot to be looking in terms of a value investor. So here's energy headline news. U.S. Permian Basin oil output set to decline by 30,000 barrels per day in June to 6.3 million barrels per day in June. First decline since January EIA. So maybe oil is going to go up. If we continue to have strong demand and the supply side starts to falter, yeah, we could see prices move on higher. Where's the extra barrels going to come from in the market to satisfy this demand? Good question. If I were to guess, maybe Canada for a while, but if the Permian rolls over, guys, this is going to get real interesting. And remember, there's been comments. Occidental Petroleum, their CEO, made comments about 2025, basically seeing oil shortages. And I am positioning as smart as I can for that outcome. Could there be short-term weakness where we go sideways or consolidate, or maybe we get weakness in the fall of 2024 and winter? Maybe, maybe not. But I kind of, those comments that some of these CEOs make, they stay in the back of my memory, and I just keep thinking, wow, we could hit a problem at some point here in the short term future, not too far out. Steven says, it was never my thinking that made the big money for me. It was always sitting tight. And that's what I've been doing. And that's from Jesse Livermore, the Reminiscences of a Stock Operator. I've been sitting tight, positioning, playing basically chess, where I'm positioning my portfolio for potential moves in the future. And then it's my sitting tight. We are seeing the technicals start to improve. Haven't broken out yet in crude oil. And they're starting to improve and or are very close to breaking out on some of the equities. So I'm getting pretty bullish here. I'd like to see that confirmation breakouts in ETFs like XOP and stuff like that. I want to read through this. So Livermore, it says, I'm buying the way up, and this is what I always talk about, buying into strength. So this is from the book. People don't seem to grasp easily the fundamentals of stock trading. I've often said that to buy on a rising market is the most comfortable way of buying stocks. Now, the point is not so much to buy as cheap as possible or go short at top prices, but to buy and sell at the right time. When I'm bearish and I sell a stock, each sale must be at a lower level than the previous sale. When I'm buying, the reverse is true. I must buy on a rising scale. I don't buy long stock on a scale down. I buy it on a scale up. That's what I call buying into strength. You're buying the stock as it goes up, and you're buying into that strength as it continues higher. That's what he suggests as a trader. I'm kind of a hybrid. I do try to buy as cheap as possible sometimes some of the stocks. If I see a commodity price bottom and it has strong technicals, I might go over to the equity side and start firing away small amounts of purchases to try to catch bottoms. I do that sometimes. So here's, I think that's Jorge. U.S. crude oil production has grown in the last year over the previous one by only 640,000 barrels per day. In last year, July of 23, it was 1.3 million. In June of 19, it was 2 million barrels. So what we're seeing is a slowdown in the production of shale. So that's what we've got there. It says if demand continues to grow to or at around 1 to 1.5 million barrels a day every year, and the U.S. is not capable to fulfill it, then the world will have an issue. And that's kind of what I'm banking on. I'm banking on the world having an issue, and it's going to be solved through prices, and that shale oil is going to, one, it is slowing its growth, and eventually will flatline and potentially start to reverse, which would not be a good thing for world oil production. Airlines face jet fuel shortages at Japanese airports. That's interesting. We've got Europe currently seeing the worst inflow of LNG since early 2022. The trend is worrying, and we are starting to see spillovers to natural gas prices. That's real interesting. So this is Europe LNG supply. Look how low it is. And this is in June. Last June, it was spiking. So, I mean, this is down quite a bit in LNG, and maybe the supply is going down because they've got higher inventory levels. Tough to say, but all I'll say is this, guys: if we have one bad, really bad winter or hurricane season or a combination thereof, we could see natural gas prices spike. I know I'm saying that from a pretty low level today, but that's going to be in the future, and we'll see what that looks like. Wells Fargo, B of A strategists say it's time to buy oil stocks. That's what they're saying, which I do like to hear. Does the oil market need to fear the gradual return of curtailed OPEC plus barrels? Even with the increase of barrels, a tepid 25 demand growth of 1.1 million barrels per day, we see global oil inventories remaining well below normal levels, suggestive of an oil price above our modeled $80 WTI in 2024 and 2025. So he's looking for continued oil market tightness in the market where it's going to drive prices on up, in his opinion. And we can see that in a graph of this move lower here on that. There it is. And the draws that we're seeing in inventory levels. And you can see that drawing down like that. The U.S. is adding more new apartments in the first half of 2024 than we did in most full calendar years over the last 3 decades. And yet demand is almost keeping pace. That is crazy. And don't give a stalled out for housing or out for sale housing market all the credit. Would-be buyers are mostly already renters, and most are or will go to SFR as life stages evolve. I'm not going to read all of this, but apartment supply is surging in 2024 and occupancy is stabilizing, is what we've got. It looks like we've built a whole bunch of apartments in 2024. This first half, more than what we have done over yearly, and it's barely keeping up. That is how out of balance we are in the housing market. Here's another quote. It says, being very early and being wrong look exactly the same 99% of the time, says Seth Klarman. And some people, the technical analysis guys, will say being early is wrong. But if you make a bunch of money and you do it over a certain time frame. So for instance, if you're early and you wait 2 years on a stock that doesn't go anywhere, but in the end, you still make a monster amount of money. And depending on how long you held it, I don't think it matters. You didn't really lose an opportunity. The opportunity was the thing that you were in. So even if it takes some time to play out and you're early and it looks like you're wrong, which you can't really tell if you are wrong or if you're just early, but you still make a boatload of money, I don't think it matters, in my opinion. Hedge funds have the lowest oil positioning ever. Worse than 2020 right now. That screams an opportunity to me. Really does. Here's gold roadmap. First posted back in 2019. It's still showing the way. Another blue mega breakout 5 months ago. Bull market price objective is 10,000 to 15,000 bucks an ounce, but could briefly go much higher at the end of the bull market. An opportunity of a lifetime, in his opinion. This is the gold quarterly chart. It says, note that the Kondratiev macro cycle is a so-called long cycle and is not to be mixed up with the comprehensive technical tool cycles analysis. Example of other long cycles are the 15-year commodity cycle plus the 18-year debt cycle, which is your real estate cycle. So there's this target. You can see how it's going all the way up there, and the possible time frame from 2027 to 2039 is this potential top for gold. And that's where I'm going to end it, guys. So that's what we've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. We still have that coupon code Mayday going on. And that's all I've got for today, guys. So we'll catch you later. This is Finding Value.